Pankaj Tibrewal joins us now. Let's take our conversation forward and understand that how is he planning to celebrate New Year this year. So Pankaj bhai, good morning. Thank you for joining us. You know, I always like your frame because when you come on, there are two bulls, you and me, and there's a bull at the backdrop. So there are three bulls in the
Absolutely.
screen now. But
Absolutely.
2022 has not been a great year for across the board market or across the board sectors. It's a year which started with a lot of promise, and in terms of where we are ending, it's a complete mirror image of what we started with. IT is down, pharma is down, banks are up, and PSU stocks are outperforming. Why is that happening? Why do we have a very divergence in the way how when we were in what we were in Jan versus where we are right now?
Uh, Nikunj, I think this year has been a classic year where what markets expected at the start of the year and what we are ending with has been completely different. If you recall, at the start of the year, markets were saying that at, at most or at the best, we would have 4 rate hikes. But as we are closing the year, we had almost 7 rate hikes and the steepest increase by US Fed in the history. Our sense is that 2023 is likely to be a volatile year for both domestic and global equity markets. We expect a more benign global economic outlook in 2023, and the outlook on inflation and its impact on monetary policy will continue to drive markets next year as well. There is a good probability that towards the second half, we will be past peak inflation and the peak US Fed hawkishness. And that should provide some relief to the risk assets like equities. Uh, we believe that in this year, at least for the domestic equities, we are almost at all times high. Valuations are not in favor of us. And I think going into 2023, we should moderate our return expectations. And our sense is that at best we should neutral on equities to start off with. And we should use buy on dips as an opportunity. And what we are advising to investors at the moment is maintain a neutral stance to equities and have a slightly overweight on large caps and slight underweight to mid and small caps. And please maintain your disciplined asset allocation, which will be a mix of both equity, debt, real estate, and a bit of gold.
So, what to your mind will be the dominant theme then? Will it be value? Will it be growth? Will it be growth at a reasonable price? What will be that theme for 2023?
So, Nikunj, let's look at 2 or 3 factors which, in our view, will decide the course of the market in the next year. The first one is that the pace of rate hikes will substantially slow down from the way we saw in 2022. But our view is that the rates can remain higher for longer as you move into the calendar year 2023, which means that all the central banks, including RBI, may have 1 or 2 more rate hikes, but they will pause for a longer period of time. And that means rates remains higher for longer. What it means is that what we saw in the second half of this year is the gradual derating of multiples and very high P stocks have seen multiple derating continues towards the first half at least of 2023. That's one very important thing to note. The second important thing to note is that there's very little room for positive earnings surprise, which we have seen for last 2.5 years. And our sense is the best of the positive earnings expectation is baked into the prices at the moment. And with the global headwinds on demand and challenges on global slowdown, we believe that there's very little room for positive earnings surprise for market as a whole into the next year. That means bottom-up stock picking will be the order of the day, and our style of growth at reasonable price should be a decent one to work out with as you move into the calendar year 23. But these are the few dominant market thoughts which we have, that rates remain higher for longer. Don't buy very high you know,
Who seem to have snapped that link.
which have a risk of stock
क्या
picking
हो रहा है यार?
and value growth at reasonable price.
You know, Pankaj, just in extension to that, wanted to understand what is it that you're doing with the two underperformers of 2022, that's IT and pharmaceuticals. Of course, not an apple-to-apple comparison, just putting them in the pool of losers year to date. And specifically talking about IT, whether you think the time is anywhere soon to start at least nibbling into the sector.
Yes, we believe that post the third quarter numbers, where we believe one more downgrade cycle could play out, we are looking at IT more constructively starting 2023. Stocks have corrected by 40 to 45% across the board. And we believe that value has started emerging there in some of the names, though they are not still very, very cheap, but they have come to reasonable valuations. We will see the commentary coming out of the IT companies during the third quarter. But I think towards somewhere in the second half of calendar year 23, IT may make a comeback. So that's where on IT we are. Second is pharma. I think our approach in this sector will be very stock specific. Though domestic continues to do well, there still seems to be challenges on price erosion as far US generics are concerned. But some of the companies on the US side are doing well. And we believe that there's an opportunity out there for some of the names, and a bottom-up stock picking approach in this sector would work going into 23. So not so negative on pharma, but a very stock-specific approach out there in the sector.
Pankaj, hi there, morning. Let's just also understand what the outlook is when it comes to betting on the entire long-term capex theme. Given the fact that India is emerging as a strong manufacturing hub, there seems to be a lot of potential to really play this vein going into the next few years. How would you like to bet on that story?
So absolutely, we believe that manufacturing as a theme is a multi-year theme, and a lot of pockets in this manufacturing theme are looking good. One is light engineering, capital goods, precision engineering, chemicals, anything to do with Euro plus one, China plus one. And many areas where we are seeing is that the import substitution is playing a very dominant role. And I think the way we are playing our bets is across these sectors as a whole. And our sense is that over the next 3-4 years, there's a very high probability that India can double its manufacturing base from $450 billion to about $900 to $1 trillion. And I think if we don't do any self-goal or don't make any mistakes, I think manufacturing can surprise us on the upside as you move over the next 3 to 5 years. And we believe that there are various ways to play it. One is the import substitution. Second is the capacity utilization, which is running at 75% across many industries. Third is the export opportunity, whether it be to Europe or to the globe. And fourth is becoming the factory to the world. We have been back office to the world. Can we become the factory to the world as you move ahead? So I think all of these are, kind of shown as a part of our portfolio if you look at the various sector composition.
Okay, so you've been talking about manufacturing, import substitutions, capacity additions for some time now, but can I ask you, more specifically, can you share with our viewers, what will it be in? Is it going to be in textiles? Is it industrials that you're looking at? Are you doing it through capital goods? How exactly should one look at this? Because this has been your big theme now, I think, for this year and the previous year.
Absolutely. And I think there are two ways to play. The first way we are playing is through the short cycle plays. So what do you mean by short cycle plays? All the bearings, the consumables, the abrasives, the ceramics, which are part of your production cycle. So when you set up an operation or your capacity utilization goes up, all these products form part of your short cycle play, and they help you ride the increase in production. So that's the first one we are playing across our portfolios. The second one is on the capital goods, where once you decide on new capex, you need plant and machinery, you need turbines, boilers, waste heat recovery, and so on and so forth. And I think that's the late cycle play. I think over the next 12 to 18 months, I think short cycle play will be the order of the day, which we have seen in the past 12 months. And as new capacity addition starts to happen, you will see that being shown up on the long cycle plays. Which also what we are seeing is that we are seeing some traction coming on the public side or the government side capex, which means the road infrastructure, the railways, the defense could be a dominant theme as you move ahead over the next 2 to 3 years. And this is the way we are playing the entire manufacturing part. Chemicals, though the demand traction still looks to be good, but valuations are not in favor of us. We have seen a significant re-rating on chemical side over the last 5 years. So multiples may not improve, and it will be more of an earnings compounding story on chemical side, but the traction on demand still continues to be very strong.
Okay. You have said already that one must be stock specific in the pharmaceutical sector. You've said in the past as well that can this turn out to be the dark horse? Right now you're talking about fertilizers, you're talking about railway stocks as well. So I want to go a little bit more in that. And that is after the run up and the multiples that you're talking about, which are not mouth-watering at all, rather very, very opposite. So that'll be still the theme for 2023, railways, defense, and PSUs. Is it time where people like you are re-rating PSUs?
So our belief is that rather than categorization of themes as a owner, what we believe is that going bottom up and selecting the best businesses in each sector would make a lot of sense. It's very easy to get carried away by momentum, but it's very important that over a period of time you maintain a balance and make sure you don't make big mistakes when the momentum or the theme is continuing. So our approach is that select businesses which can show predictable earnings over a period of time, where balance sheet and cash flows are strong, and you are not dependent on only one entity as your customer. And I think that's where our thought is. We have been positive on few PSUs, not from today, but for last couple of years on defense, and that has played out well. And we believe that if the demand traction continues on both domestic as well as on export side on defense, there will be few names which probably show signs of promise as you move into the next couple of years as well. So rather than categorization as a basket, I think it will be more as a stock-specific approach in each of the themes I spoke about, whether it be industrials, capital goods, defense, railways, or anything to do with domestic, economy. And I think most of them, one should be careful looking at valuations also. It should not be that we get carried away by the recent momentum and by anything.
Pankaj, on that happy note, we let you go. Great to have you on ET Now as always.
Thank you, and wish you and your entire team and the entire viewers a very Merry Christmas and a Happy New Year. Thank you so much.
Same to you from all of us here. Wish you a happy, healthy, prosperous 2023. Well, India will continue to outperform.